Thank you. Our next item is going to be the approval of our minutes from our open session board meeting of January 25th, 2023, which are in your packet. Motion to second, please.
I move that the minutes be approved as distributed.
I'll second that motion.
It's been moved and seconded to approve the board meeting minutes from our open session of January 25th, 2023. All in favor? Opposed? That motion carries. Our next item is the closed session board meeting minutes, also from January 25th, 2023, which were distributed prior to the meeting. Motion is second, please.
I move we approve those.
It's been moved and seconded to approve those closed session minutes from January 25th, 2023. All in favor?
Aye.
Opposed? That motion carries. Any communications from board members that they'd like to share over the last month, or nothing from staff? We will move into, I'm going to pass this off to Carl. We're going to have a presentation by staff followed by a presentation on the fiscal year 2022 audit from Martin Hood. Carl.
Thank you. Yes, we've got our, Natalie, if you want to come, are you staying there? Oh, okay. Change of plans. No one told me. So we've got Natalie Pritchard here from Martin Hood to give our annual presentation on our annual audit, but also joining me at this table are Michelle Wright, our finance director, and Nate Warman, our comptroller, and they're going to be part of the Natalie's backup team on her presentation. But just prior to that, Michelle has a little bit of information to give you, just to remind you about some of the GASB requirements, and she's going to explain what GASB is to refresh your memories, because you probably block it out of your memory just like we do. So Michelle.
Yeah, we're very excited to present the audit today. Nate has put in a ton of work on this, as well as Natalie, and I've helped some. But the whole staff are really excited to present this. But it does look a little different this year. And so I wanted to explain one of the major reasons it looks a little different this year, and the timing's a little different, is because of GASB 87 and GASB 96. I don't know if you have the slide up, that'd be great, and if not, it's in front of you here. The Governmental Accounting Standards Board is really not part of the government. It is an independent private sector organization, but they set all the accounting rules for governments. So to follow generally accepted accounting principles, we have to do what GASB says. So we get to implement GASB 87, which is about leases, and GASB 96, which is about technology subscriptions. For the next slide then, before GASB 87 came, and this is the first year for GASB 87, and you'll notice as we go through the audit, we don't have comparison statements this year. Normally we show what happened in fiscal year 22 compared to fiscal year 21, but to do that we would have had to restate all of 21 also for GASB 87 and 96, and rather than do that, we're just showing the 1 year, fiscal year 22. Once we're good on that, we'll go back to comparison statements. But before GASB 87 happened, when we had an operating lease, we would record it as expense as we made the payments. GASB 87 is an attempt to show that the things you're leasing are sort of capital. And to do that, instead now we record a right to use asset, and that asset is amortized. And then we also record a lease liability. And as we make our lease payments, that lease liability is reduced, and then part of the payment, we do a calculation to estimate the interest part that would be part of that. So in our statements from the audit, the leases are all going to show now as lease assets, lease liabilities, and that type of thing. So Natalie will explain more about that. This does also impact when we have people paying us rent. We had to do restatements for all of that also. But it's just this GASB 87 that's going to make the expenses look very different than they had before, and the balance sheet. One other short difference between both 87 and 96, even though we need to record these things to be compliant with GASB and generally accepted accounting principles, the state of Illinois has said that we can still submit our lease expense and they will pay 65% of that. So during the audit, you will see this GASB 8796 presentation, but the monthly financial statements will continue as we have without showing those items, and then we'll update those at the end of the year. We are, though, now keeping track as we go along. What took so long this year was we had to go through every single lease, every single technology arrangement, and see if it fit the criteria set forth by GASB 87 and 96, and that took a while. But now we've got a great list. Nate and Victoria Carrington, our finance and procurement specialist, dug into GASB 87. We were excited to learn, Victoria attended a webinar that we're on the cutting edge of GASB 87 implementation, so that was great. Real quick, GASB 96 is really the same type of idea as GASB 87, except this is for when we sign up for licensed software, and we're basically just paying to use the software. We're treating that then as a subscription-based information technology arrangement, the same type of deal. We used to be able to just expense those. Now with GASB 96, we do the right to use asset, amortize that, do the lease liability, do the lease payment. So I just wanted to let you know here, since this is such a big difference in the way things are looking, I just wanted to give my 2 cents before Natalie explained it all. That's all I've got. Phil.
Are we reasonably confident that the state is going to continue to let us, not just this year, but going forward, treat these as operating expenses? For the
We have
purpose of the
emails from
downstate
them
rate?
stating that that is what we can do.
Excellent.
Just to piggyback on that a little bit, there is statutory language that backs up their current perspective of continuing to support these assets, which are typically considered capital, but as an eligible operating expense. The statutory language within our Downstate Operating Assistance Program Act specifically says debt service and interest. So the principal and interest on debt service items is eligible for operating expenses.
Very good.
Okay, you want to move into your report then, Natalie? Thank you.
Yes. So thank you for having me here today. Unfortunately, Greg Douglas, the audit director, and Dave Hood, the engagement partner, were not available to be here today, so it's just me. But I will touch on our auditor's report that covers our 5 tasks in the audit engagement and the other communication letter that we issued. These are all located on pages 4 through 98 in the board packet. So the page numbers that I referenced throughout will be those red page numbers in the board packet. Our first task was an audit of the financial statements. Pages 7 through 10 is our independent auditor's report. We've issued an unmodified clean opinion, which is located in the second paragraph on page 7. This report covers all sections of the audit document except the management discussion and analysis on pages 11 through 21 and the required supplementary information found on pages 54 through 57. The sections that are not covered by our auditor's report are known as required supplementary information. We read these sections and make sure that they're consistent with the financial statements and notes that we've audited, but we don't issue an opinion on those sections. We do issue an opinion on the regular supplementary information, which are the schedules on pages 58 through 78, and we compare this in relation to the main financial statements. This in relation to opinion appears on page 10 in the partial paragraph's last sentence. And again, we have issued an unmodified clean opinion. And what that means is that the financial statements and the note disclosures are proper in form compared to generally accepted accounting principles, and the financial statement and note disclosures are supported by the district's underlying accounting records that we tested or third-party confirmations that we received. On pages 11 through 21, the management's discussion and analysis, this section provides a synopsis of the financial statements from management's point of view. This is fully prepared by management. We encourage you to read this to get a quick summary of the rest of the financial statement packet and to get management's comments on that information. Our second task was to provide assurances on the district's compliance with the Downstate Operating Assistance Program grant. On page 65, Schedule 3 presents the calculation of the grant amount for fiscal year 22, which is roughly $22,000,000 $774,766. On page 67, Schedule 5, this presents our conclusions on compliance for that grant. Items 2 through 5 note that the district has complied with all the grant requirements that we tested. Our third task was to provide assurances on the district's compliance in relation to CCART's Downstate Operating Assistance Program grant. On pages 72 through 73, Schedule 8 presents the calculation of the grant amount for fiscal year 22, which is $362,145. Similarly, on page 75, Schedule 10 presents our conclusions on compliance for that grant. Items 2 through 5 note that the district has complied with all the grant requirements that we tested. Our fourth task was to report on internal controls and compliance in relation to the financial statements. This report appears on pages 79 and 80. We do not provide an opinion or any assurances on internal controls. We would only report any deficiencies that we identified during the financial statements audit process or note that we identified no deficiencies. On page 80, the first full paragraph, second to last sentence, it notes that we identified no deficiencies in internal controls related to the financial statements. Also on page 80, the second full paragraph, last sentence, notes that we identified no instances of noncompliance that would impact the financial statements. Our fifth and final task was an audit of the district's major federal program compliance and to report on internal controls related to major federal program compliance. On Schedule 11, which is on page 76, it presents the district's federal award expenditures for fiscal year 22, which totaled just over $9.4 million. The program with the asterisk is the district's major program that we tested in detail during our federal compliance audit. This program is known as the Federal Transit Cluster. These funds were used to purchase capital assets and to support district operations. The narrative report appears on pages 81 to 83. We do provide an opinion on the district's compliance with its major federal programs requirements. That opinion is located on page 81 in the second paragraph. And once again, the opinion is an unmodified, clean opinion. The remainder of the letter is our report on internal control related to federal award compliance. We would only report any deficiencies we identified during the federal compliance audit process or note that we identified no deficiencies. On page 83, in the third paragraph, second to last sentence, we note that we identified no deficiencies in internal controls related to federal award compliance. And on Schedule 12, page 77, it provides in Section 1 a summary of all of the reports that I've discussed. In Sections 2 and 3, you can see that there were no findings resulting from the audit of the financial statements or the major federal program. And moving on to the post-audit governance letter, this is on pages 84 through 98. This letter essentially communicates how the audit went operationally. At the bottom of page 84, we begin discussing the significant estimates that are part of the financial statements, and this carries to the top of page 85 where we actually list out those estimates. And we evaluated the estimates and found them to be reasonable. Continuing on page 85, about halfway down the page, we identified notes 13 and 15 of the audit report document, which are related to the district's IMRF pension and other post-employment benefits plan as particularly important notes to bring to your attention. There are a handful of sections in the letter that discuss any problems we had in dealing with management during the audit. Those sections are the difficulties encountered in performing the audit section on page 85. On page 86, the disagreements with management, management representations, and management consultations with other independent accountants. And on page 87, the other audit findings or issues section. Except for a description of the delay in completing the audit and the difficulties encountered section on page 85, none of these sections disclose a significant issue. I do want to note in the difficulties section, as Michelle mentioned earlier, adoption of the two accounting standards noted, GASB 87 and 96, were a big part of the delay in completing the audit. These are very difficult and intricate standards to interpret and adopt, and we commend management on their meticulous work in this adoption process. We also want to point out that management was able to adopt Statement 96 1 year earlier than required. On page 86, at the top of the page in the section titled Corrected and Uncorrected Misstatements, we discussed the 11 pages that are attached to the letter. The first 9 attached pages, which are pages 88 to 96, we present adjusting journal entries identified during the audit that the district will record in its accounting system. In most of these descriptions, you can see that a lot of these entries were provided by management and were not identified as a result of audit procedures. On the 10th attached page, which is page 97, this presents the reclassifying journal entries made only for the presentation of the external financial statements. These reclassifying entries will not be recorded in the district's accounting system. The last attached page, page 98, presents the adjusting journal entries that were identified during the audit that management chose not to record. The total impact of these unrecorded adjustments was not significant enough to the financial statements, either quantitatively or qualitatively, to change our unmodified opinion on the financial statements. And finally, on page 87, the Other Matters section describes what procedures we performed on other sections of the audit report document. No significant issues were noted in this section. And to wrap things up, we do have some additional post-audit tasks. These include compiling the annual financial report for the district's submission to the Illinois Comptroller. This filing has been prepared and was sent to CMTD management yesterday for approval and submission. So this will be ready just in time for the February 25th deadline. Our second task is to initiate the federal single audit data collection form for submission to the federal single audit clearinghouse by the district. That filing has also been prepared by Martin Hood and was sent to management last Friday for approval and submission, so it will also be ready before the due date of March 16th. I'd like to wrap things up by stating that it was really a pleasure working with management and staff throughout the audit, and we'd like to specifically thank Carl, Amy, Beth, Michelle, Nate, Jane, Debbie, Victoria, and the many other staff members that we worked with throughout the engagement. Their thorough preparation and responsiveness make a great difference in the audit process. And at this point, I'd be glad to answer any questions that you may have about the audit or the financial statements.
Thank you, Natalie. Any questions from board members for Natalie on the audit or staff?
What did the audit cost?
As soon as I go back to my computer, I'll look that up and I can let you know.
I'm sorry, couldn't hear that.
I need to look that up in my computer, which is right behind me, and I'll let you know that for sure.
Also, maybe I was out to lunch or something, but I don't remember seeing this type of information about C-carts included in previous audits. Was it in a different format, or is this a new thing?
So this is not something that's new. This is how it's been presented over the last couple of years.
Anything else for Natalie or any other financial staff on this?
Mr. Chair,
Go ahead.
if I could just real quick. Nate and the staff does a lot of work on this, but these results are not possible without the magnificent attention that the staff and operators and all management and everybody that works at MTD, if they weren't following internal controls and trying to do the right thing, these results would not happen.
Absolutely. All right, well, with that, I'm going to, on behalf of the board, thank Natalie for her work on this, staff, everyone from Martin Hood that also participated in preparing this report and generating these reporting changes that are going to we'll be looking at again in the future. So thank you. We will accept and place this report on file. At this point, we will move on to the managing director's report. Thank you, Natalie.
Well, while we are doing a group hug, I will just also say, audits generally aren't something that engenders a lot of affection for the parties involved, I think, but, we hired Nate away from Martin Hood, and that's always causes a little concern about how future audits will go. Natalie has been great to work with. This has been a particularly challenging audit because of the new rules that we had to implement, and Nate and Michelle and Natalie are a good team that work together, and those of us that are kind of on the periphery just watching and just occasionally making problems for everybody else, they're great to work with, so I appreciate that. Moving on to the management report. This is for January statistics, and so January is one of those goofy months for us because 3 weeks out of the year, or almost 3 weeks out of the year, we're on winter break, and so we have a suppressed level of service, suppressed demand, and therefore suppressed ridership. But you can see that our the monthly ridership still was 41% higher than it was in January of 2022. So that is a significant increase, and because of the COVID dip that we have in our 5-year average, I think we're going to be seeing, our monthly numbers exceeding generally our 5-year average even. So just a strange turn of events. Our year-to-date ridership, we had 4.8 million, and last year at this time we had 4.1 million. So that's almost a 16% increase. And then I've got, I think both charts are in this. Yeah, this is just a visual for you to see how the month went. You can see how winter break is fairly flat, and then, boy, the students come back and the university lights come back on, and ridership really kicks up. So kudos to operations and maintenance for keeping up with that and staying on top of it. And then just a year-by-year ridership scenario. You can see pre-pandemic, we still have a little bit of pre-pandemic time left in our month-to-month comparison. In 2020, the 838,000, and then just the significant drop, and we're stair-stepping back, and like I said earlier, 715,000 in this past January. So we continue to approach where we were pre-pandemic.
What was 2019?
Yes. Sorry?
What was 2019? The January.
I'm sorry, can you pull your microphone down to your, I can't hear you, Bruce.
What was 2019 on that last chart?
What was 2019? Well, I don't have that right in front of me, but give me just a second.
That's what you've been comparing to.
Yeah.
2020.
I can give you the monthly, January of 2019 was 1,022,403.
Because 2020 has a little pandemic in it.
Yeah, I mean, we didn't have any of the shutdown yet, but certainly there was a lot of talk about the pandemic in January, and so maybe there was some impact. Generally speaking, January 2020 is in fiscal year 2020, and that year had been, we were seeing an increase over 2019 until the pandemic came in and sort of pulled the rug out from underneath us, even though in January the numbers were not as high as the previous January in 2019. But yeah, in general, that year was looking like it was going to be a better year until the pandemic.
Maybe when we compare in the future, we'd want 2019 to show up here, because it's the first full year with no pandemic.
Sure. Yeah. Maybe I kind of put some thought into this and talk to planning and see if they have any thoughts on it. But maybe instead of this 5-year average, which in some respects has become kind of a useless statistic because we have this anomaly now that's right in the middle of it, it may be we take a look at doing something different and do a 2019, 2020, and then now a 2023 comparison. So yeah, let me think about that and talk to the rest of staff and see if we can come up with something. Okay, moving on to the monthly operating revenue, January 2023, we had a 4.6% increase over January of 2022, and a year-to-date operating revenue was 6.2% above FY 2022. So revenue is looking pretty good. The monthly operating expenses, we were 6.3% above January 2022, and operating expenses were 6.4% for year-to-date above FY 2022. When we compare to the budget, the year-to-date operating revenues are almost $1 million above budget, and the operating expenses are almost $4 million, $3.9 million below budget. And just to state the obvious, that's because we budgeted for a full level of service and we continue to operate at an 80% level. So even though the expenses are increasing compared to last year, they're quite reduced relative to the budget because we still haven't been able to get back to 100% of our service. And with that, I will take any questions that you might have through page 127.
Questions for Carl on his report?
An old point, Carl. Couldn't we use graphs instead of bar charts? You'd save a ton of ink.
We don't do very many printouts, Bruce. I appreciate what you're saying, but I'm looking for legibility and understandability before saving ink, because we really don't print very many hard copies of this.
All right.
But I hear you. I hear you.
And it's also easier to read charts.
Well, maybe we can do a survey and see what the board wants. We can do a version of each and see what the board prefers.
I mean, even if you don't print it, those pixels are sucking up electricity, Carl.
There you go. Yeah. Fair point, Phil.
Margaret, go ahead.
Are you going to talk about item 4 in your notes?
I can. Let me look to see what item 4 is.
Local Government Efficiency Act?
Okay, so that's item 3. Yes. Sure. I've sent some messages out to the board about this, so I think all of you should be aware of this. But last year, the Local Governmental Efficiency Act went into effect, and it's a state law that is requiring every basically municipal or non-municipal taxing authority like MTD to form a committee to study the efficiency of the management and function and operation of the particular district. And so the chair and the vice chair and I have been having conversations about who to include on the committee. The law requires all of you to be on the committee, so it's a committee of the whole of the board, and then the managing director of the district is a member of the committee, so me. And in addition, we have to seat 2 community members on that board. So we've got a short list of names of people that we're going to reach out to. However, if any of you other trustees besides the chair and the board chair, if you have any people that you think would be good for that committee, then you can give me names to add to that list. Then once that committee is seated, we are going to go out to bid on a consultant to do this study on the efficiency, because it's a little, the law is very vague about what is supposed to be accomplished with this. And so rather than staff and certainly rather than the board having to put a lot of time into this to figure out exactly what the study should entail, we're going to hire some consultants who can assess what needs to be included in the study and then do the study, and then we have to report to the county board on the study. And that's just one of these things that Illinois requires us to do. So, it should be a great time had by all, and we'll get going on it as soon as we get the committee seated. Any questions about that?
And I'll just mention to the rest of the board that the other two, the community positions are voluntary positions. They're
Correct.
not compensated in any way,
Yes.
other than our gracious thanks to them for participating. Any other questions for Carl on his portion of the report today?
Mr. Chair,
Go ahead.
I do not have a question, but I do have an answer about the cost of the audit. The fee in the engagement letter was expected to be $36,000, which covers the audit and the annual financial report preparation, both for the district and the CCARTs. And then in addition to that, there will be charges for helping with the GASB 8796, and I can come up with a complete cost of what was actually spent at a future meeting.
Very good, thank you.
Thank you.
All right, with the completion of the managing director's report, the next item that we have for reports is the committees of the whole assignments. We're just going to leave those committees as they were last year. Everybody will just remain in their current positions on that. Our next item is our action item for today's meeting, and that's our experience credit for wage scale placement.
Yes, and I have asked our HR director, Jacinda Cromer, to come up and give you a presentation, and buckle up, because this is good stuff. This is exciting. So, Jacinda.
I'm not sure I can live up to that. Hi, everybody. I'm Jacinda Cromer. I'm the MTD's HR director. On page 128 is a memo that proposes giving credit, some experience credit for work history that is relevant to the current role or the hired role at MTD. And so our current and historical practice is to, for hourly employees, is to start somebody off in their position regardless of experience at the start of the wage scale. So I'm going to move away from the memo, and we'll go into the presentation. I believe you have copies, and it's presented here. So next slide. My proposal for you is that we adopt a new hiring practice that allows credit for that relevant work experience for new and our current hourly employees. Next slide. So we've got some current challenges that have brought this to light that I want to point out, like why am I here today asking for this particular proposal? If you go to the next slide, I just want to kind of show you what a wage scale looks like. This is our technician wage scale that's on it's the first little chart. It shows the full-time 0 to 12 months. That 65% means 65% of the top rate. So the highest a technician is getting paid currently at MTD, you go all the way down to the bottom of that chart, and that pay is $35.67. So in the first year of placement in this position, they'd be 65% of that top rate and starting out at $23.19. The way our technicians and all of our hourly employees work is that every year on their anniversary date, when they've been here at 1 year, they moved to the next step. So then they would move to 70% and be making $24.97. On the second year, they'd move to the third step. So each wage scale has different amounts just based on the particular job and the duties and responsibilities of that job, but it all works exactly the same. You'll see that this particular scale has 8 steps, and most of our scales have between, I'd say, 6, 7, or 8 steps. So it takes 6, 7, or 8 years to reach our top rate, starting at the beginning. Next slide. So I want to tell you a little story of two technicians. These aren't real technicians, so we don't have new hires. Josh Beerbaum, Maintenance and Facilities Director. These are just fictitious to kind of illustrate our current challenge. So let's say we hired two technicians on the same date, Jane and Jaden. They were hired February 15th of 2023. They both have experience and that background of graduating from Parkland's diesel program Jane this past December 22, but Jaden graduated it from 15 years ago. And so, they have that base foundational knowledge. Jane's right out of education, hired. She has no experience whatsoever. This is her first job. Jaden worked as a technician somewhere else, 15 years working on diesel buses and trucks. And so our current practice would be, as I think you'd guess, next slide, would be to place them both at the bottom of the scale, at the first step of the scale. So Jane and Jaden both would be making $23.19. So it doesn't illustrate or value that experience that somebody brings into the position. So that's a concern, and a concern that employees have brought up, and it makes it very hard in the current hiring landscape to compete with other employers in this area. Go to the next. And so I looked up, what are other employers paying? What are other employers posting their jobs? And these are real postings from the last few weeks for mechanics and technicians. And what I noticed is that in our job posting, we say hiring at, and then we post 23, was it 19? I think so, 2319. And there are several jobs that will list a range. And so it'll be 20 to 24, 15 to 20, 18 to 37. And of course, there's the little tagline at the end of those postings that say, based on your experience. So they're valuing experience. We're just starting somebody out on step one. So these are mechanic and technician postings, but this is not the only type of hourly positions that we hire for. So if you go to the next slide, these are CDL driver postings in our area. And so not all of them have ranges, but I wanted to illustrate a couple others there, but there are several that have ranges and value that experience. So 20 to 26, you can move forward. Other postings, we have security employees that work here at Illinois Terminal. We have our, of course, information assistants that work at the desk downstairs, as well as answer phones at the desk over at 1101 administrative offices. And so there's ranges often posted. And so, people say, well, why would I start necessarily at the bottom here when I can go find something else and get a little bit more because they're valuing that experience. So that's what we're competing with. Move on. So my proposal to you, and I know I'm going quickly through, it's probably hard for you to keep up, but I propose to follow the same proposal or work that Gallagher did. We hired that consultant to do our compensation study, and they finished that study for us in December and presented it. And then you've received the full report. In that study, it illustrated how we were valuing experience for our salaried employees, which we have done and we have implemented this current fiscal year. We had conversations with salaried staff and found out their previous work experience and gave them credit on that salary range so that we could retain our great staff. So we've worked in that new philosophy in our salaried, and I'd like to do that same model with our hourly and follow these same guidelines that consultant did for us in that study. And so what they proposed is that if the job was a same title job, the exact same job title, or at least job duties, as whatever their current position is in MTD or their hired position, that it would be that would be one level of prior experience and be considered same title. The next step would be relevant. Oh, not next slide. Back. Yeah, relevant experience. So experience in the same area or function or department, but not necessarily the same title. Maybe think of it as like the step below. I've got examples here in just a second we'll come to. Then somewhat relevant is experience in related job functions, but not quite the same job function. And then of course work experience that's not relevant would be things that we would not necessarily count. So those are the tiers that were identified and that I would propose to use in this new policy. You can go to the next slide. So some examples of what prior experience might look like across those different tiers for these roles. Two of our main categories of hourly, of course, are our maintenance technicians and our bus operators. And so an example of a same title for a bus maintenance technician here would be a diesel technician. So that would be, same duties, not necessarily always the same exact vehicles, but that's the case for any job and across a different organization, but certainly the same responsibilities. Then auto technician would be considered relevant experience. So, it's working on different types of engines from what I understand. And then of course a tire mechanic, it's maybe more specialized or just a certain part of it. So it's somewhat relevant, but not directly relevant or exact. So that would be examples of that. For bus operator, it would be, same title would be a bus operator coming from a different industry, or I'm sorry, not a different industry, a different transit organization like Danville or CTA or any of them across the country. And we do have operators who come with that experience to us. A school bus driver would be considered relevant. That might be an example. And then a truck driver, of course, have to hold a CDL and understand how to drive that large vehicle, so it'd be somewhat relevant, but they're not driving passengers around. They're not necessarily doing the fixed routes in our town, so that's sort of how it would step down. Next slide. And then I propose to use the same calculation as we did for our salaried staff when giving credit on the salary scale, as I would for these hourly employees. So a same title would be a 1-for-1. You worked 1 year as a bus operator somewhere else, we'd give you 1 year credit here on our wage scale. If it's relevant, it'd be 1 year would equal half credit. So you'd have to get 2 years of bus operator experience in another transit organization or agency for 1 year's credit here. Somewhat relevant would be 0.3. And then, of course, if it's not relevant, then we would not count it on the wage scale because that experience isn't going to necessarily add value to what they do here at MTD. Next slide. The way I would do it is that I intend to draft up some employment verification forms that employees would be able to come pick up or print out, where they would list out their prior job titles, where they worked, the months they worked, some of their job duties, and they would actually take it to or send it to their former employers and get that employer to verify it. We do that verification all the time in our offices. HR and other organizations are used to this sort of thing. Like it's just an employment verification to say, yes, this person did this job, these dates, I agree with it. The HR director or the manager or the owner of whatever that business is would sign off on it and then fax it or email it back to us, or maybe the employee would bring it back to us, but then we could always call that organization and would call those organizations directly to just do a verification of authenticity of that form and make sure, if we're gonna give this credit, we wanna do it a very specific way. So that would be the process for that. I'd put the work in the employee's hands, have them get the forms to us, and then we could move them on the wage scale. Next slide. Of course, this is going to have some budgetary impact, so I wanted to outline what that would be and give you a couple of options actually to discuss and think about. Next. So I dug through employment records or personnel files of our current employees, and I looked at all of their original applications. So we have hard copy applications that we've had used and printed off, and so they're housed in everybody's personnel file. And so I pulled those out and tried to identify what I thought would be same title, relevant experience, somewhat relevant experience, and put it into a big spreadsheet to calculate out. In operations, we currently have 224 operators, and that's across all of our programs. So that's the fixed route, the C-carts, and our ADA drivers. And so of those 224, there's about 100 that are already at the top of the scale, top rate. And so I didn't have to look at their applications. There's nowhere for them to move. So I dug through the other 124 operators and looked at their applications and identified, I think there's 35 employees who bring past experience with them that they don't have credit for at this moment. So that's 16% of that workforce. And for maintenance, I believe that's 14 out of 48, which is 29%. And the other means security, the Illinois Terminal Maintenance Group here, as well as the Information Assistant Customer Service Group back at the administrative offices. So 8 out of 19, and that's 42%. So a total of 20% of our workforce would get some sort of credit on the wage scale if we move forward with this proposal. Next slide. But I didn't stop there. I calculated what that would be. So I identified how much would be considered same title, half credit for relevant, somewhat relevant, and so forth. And at first, my first calculation was saying, what if we gave them all the credit? So I'm not going to put a cap on this at all. What if somebody comes in with 20 years of experience as an operator and we just put them right to the top of the scale? What would that budgetary impact be? And so that's the first column there. In operations, it would be $403,000, and that illustrates the difference in pay. So that doesn't count what we're paying them now. That's $403,000 on top of what we're paying them now. So it moves them. It's just about that scale movement. In maintenance, you would see it's $128,000. Other, for those 8 employees, I think, $35,000. So we're close to $600,000 there, $566,000 to be exact. And then, I also recalled that in that compensation study from Gallagher, they said and told us frequently through that work that it's not necessarily best practice to bring somebody in and put them at the top of the scale immediately. Usually when we hire people, if they come in with even great expertise, you should hire them at the highest, at the midpoint of the range. So if you think of the scale from the minimum to the maximum, that 0, that first step, to that 8th step of the wage scale that I showed you, we shouldn't go really higher than the half, because we want to give people growth and raises and that show that improvement over the course of the years. So I don't recommend that we go full credit. I recommend that we do a cap, and I think it's debatable kind of where that cap is, so that will be open for discussion at the end of this. Do we cap it at 3 years of credit? Do we cap it at 2 years of credit? So I downscaled all of that data I did and identified how much that would cost for our current workforce. So it's, I think it will be currently about $400,000 or $316,000 based on which direction we go. Next slide. We have vacancies, though. We have a handful of vacancies. For example, we've got 30 vacancies in operations right now. Oh, well, it says 36 right now. And so I took the patterns or the math, really, that came from all of the data when I looked through people's applications. And I said, if the current vacancies were filled immediately, right now, at what rate do we think that they would come in? Like, how many of them do I think would come in with past work experience? Well, I know how many are current workforce because I looked through the applications. So I said if they came in about the same proportion, so I had to kind of make a guess about who our future hires would be, and I applied that same proportion to this particular graph. So I estimate maybe 6 of our future hires in operations would come in with experience, and I again used the same math formula and applied it. So these are more estimates than the last slide, of course. So if we did the award full credit for our vacancies, there'd be about 78,000 extra, but of course I recommend the cap at either 3 or 2, which you see there at 52 or 41,000. And then the second, or the next slide, just puts that all together for you so that you can see it together. If our current workforce comes with all of their experience, plus our future, hopefully, workforce, and we fill those vacancies, we're looking at 350 to 450,000. As I was digging through applications, I was rounding up to make it easier for me. So I know on the memo, I quoted 300 to 400. I think in actuality, because I rounded up a little bit more, that we would, it would be closer to the 300 to 400. Next slide. I recommend that we kind of stick to either the 3-year or the 2-year cap. And if you go to the next slide, that would mean if we hired Jane and Jaden, of course, Jane doesn't come with experience. She's a great hire. We're happy to have her. She's not real, so I'm just, again, fictitious. But 2319 is what Jane would start at. And Jaden, if we capped at 2 years, would be at 2675. At 3 years would be at 2854. So it values some of that experience, but gives him room to grow. And so my final slide just kind of pulls it all together. I put the recommendation here again. I still think we should adopt a hiring practice so that we can compete with other organizations and also give credit for the experiences that people bring to MTD. I think there's a lot of value there. And so I'd like to just add the little caveat that it should be capped at 2 or 3 years, depending on what we think is the right direction for MTD. So that's the end of my presentation, and I would be happy to take any questions about any of this data or presentation.
Questions for Jacinda or Carl on this? Phil?
I suppose my first question would be that we obviously have other practices based on seniority, like choice of shifts, et cetera. Would those be affected by this as well?
None of that would be affected.
Bruce, you have something for Jacinda?
Yeah. So the wage rises go for these technicians, these diesel technicians, for 7 years, and then they freeze for after that.
They don't totally freeze because we do the COLA raises. So every July 1st, the entire scale moves up. We just agreed, of course, for the COLA raise for this July 1st would move a certain amount. So everybody gets that raise. They wouldn't get the second raise. Typically, our employees will get 2 raises, the July 1st COLA and then the step raise on their anniversary date, so their higher date, until they reach top rate. So that raise would stop after they hit the top of their wage scale.
You figure they don't get any better after 7 years.
I think they get better, of course, but that's a pretty common practice. You know, we all have wage ranges, and it's about making sure that our wage range stays up to the market, which is why we do things like the compensation study. And so we might decide sometime, oh, this scale needs to be adjusted because maintenance technicians in this area are getting paid more. So let's move, which is something we have recently discovered. And so we're trying to move that entire scale on top of the COLA. So everybody, of course, benefits from that wage scale, and then they would get an additional raise when that happens.
Additional questions for Jacinda or Carl on this proposal? So I have a question on, so most recently we did this with salaried employees. Did we put a limitation on the years of credit or experience that they received? How was that initiated?
Well, we haven't made all of the corrections for salaried yet. We started to do it. It's going to be like a 3 to 4 year process. And so we're only like at least a third of the way to do that. Not everybody or anybody went to the top. So it did kind of land people a little lower. But again, we're doing it in increments. In this case, I want to do, if this moves forward, we would move somebody, if they have the 2 years, we'd move them immediately. We don't want to do it across 3 or 4 fiscal years.
Sure. Sure. Well, probably my concern would be making sure that employees are being treated equally.
Right.
So we don't want to do anything that's radically different for one group of employees, hourly employees versus salary employees. So I want to be assured that that's not going to be a concern somewhere down the road where people are feeling like they're getting a raw end of a deal on something here. Go ahead, Carl.
Yeah, if I can briefly speak to that. What Jacinda was just saying that we did with the salaried staff and kind of shooting for that mid-mark is similar to what we're doing with what we're proposing with the hourly here. I do want to note, though, and this is just a reminder because I've expressed this to you before, when you compare, like our compensation study did, the majority of our hourly employees, they are in a much higher percentile to their peer categories across the country in the transit industry. So our hourly employees are doing very, very well percentile-wise, and our staff, much of our staff is in a lower percentile when compared to their peers in the transit industry. And so they're being treated the same, but I just want to put out there that there's a little bit of inequity built in there already favoring the hourly versus the salaried.
Sure. I just want to make sure that we're, from a perception standpoint for the employees, that there's an understanding that that is built in. So everybody's got the same information, I guess. So, any other questions on this proposal from the board? With that, I will ask for a...
Brad.
Whoop, I can't see your thing. So
No, you're good.
missed you.
I don't know. This is an interesting proposal because I've obviously recommended people to come here and we run into issues where, well, it's night shift or it's not as much money as I'm making now, and they haven't taken it. On the other hand, I really like the fact that we have so many people that started their careers at MTD and have been here the whole time. In my own business, that's, been at the same company for 22 years. It's kind of fun. But you do tend to hire people that are going to be around longer. You're hiring people, I guess, that are younger, maybe have fewer bad habits where they're not bringing something that they learned somewhere else and insisting on doing it their way. They're a little bit more malleable or whatever. So I do, not just for budgetary concerns, I do kind of like your idea of capping this at a few years, just because we do have a limited number of slots, and I do like the idea of sort of hiring from within and making people feel like their seniority is valuable, they're proud of it, rather than getting a bunch of people who are sort of in this modern thing where we switch jobs every 2 years, trying to get a higher salary. It's nice to have that continuity, especially with weird things like hydrogen buses and hybrids, and a lot of this technology, it takes a long time for us to get the institutional knowledge to maintain, and I think that's what makes this place special. So I don't know. I mean, I understand why we're doing it, but it does bring some concerns, and I don't know if you guys have thought that through at all.
Yeah, if I could, real quickly. First of all, I'm going to push back against hydrogen being a weird thing. I would say it's a great thing and a really cool thing, not weird. But that aside, I can appreciate what you're saying. That is, and I know HR does too. That is why we have proposals with a couple of different tiers for you to choose from. I mean, I want you to have a discussion discussion about what you think you have an appetite for fiscally and select a tier. Should you choose to move forward with this, then select a tier that you're comfortable with. Staff had reticence about just going all in and saying we're going to do a 1-for-1 with no cap. That would be that's a little rich, and it doesn't accomplish what Jacinda was referring to earlier, that we want people to be able to advance and improve their income as they're here, and that actually incentivizes people to stay. If they just get the max right out of the gate, then that removes some of that incentive. So we don't want to remove that incentive, and so it's always trying to find a balance, and we don't always strike the middle perfectly, but that's what we're aiming to do. When you start talking about what tier is the appropriate one, something else that I would like to, and I didn't mention this to Jacinda that I was going to say this, but one thing that I would like to also put out on the table, we're just starting work on the budget for next fiscal year. And one of the things that I'm looking at earlier on in the presentation, you saw that sample maintenance technician wage scale. That's our real progression rate. When we hire somebody, and if they start at the starting wage, it takes 8 years for them to get to the top rate. That is an extraordinarily long progression rate, even just within the transit industry. I see you nodding your head, Brad. I'm sure firefighters would look at that and just think, what, 8 years? Yeah, well, 5 years is actually a little long. I was just about to say the average for transit is 3 to 4 years for a progression rate from starting to top rate. And so we're double that. And one thing that I'm looking at for the next fiscal year is lopping off that bottom tier, which, it only reduces it by 1 year. And so it would be a 7-year progression rate instead of 8. But there's going to be a cost associated with that. And so, like I said, I didn't tell Jacinda I was going to say this. My recommendation would be that you select the cap at 2 years rather than 3 years, because improving the financial environment for the employees. We absolutely want to do that. We want to retain and attract new employees, but we also have to be fiscally responsible. And so we're trying to find that balance. So that would be my recommendation.
Margaret.
Well, Mr. Chair, it seems to me that before we vote on the proposal, we need to decide whether we want 2 years or 3 years, or are we going to leave that up to Jacinda?
Well, I don't think we're going to leave it up to staff to make that decision, but I think with this additional information that Carl has just provided us about more of a long-term approach, and I think his recommendation is the 2-year cap, tied to reducing the span of the top tier. I think that might be the appropriate approach. And I guess if there's no other questions or discussion, I will ask for that to be our motion, that we adopt a 2-year cap for experienced hourly employees.
I'll second that.
Whoops.
Sorry, can I ask for one little add-on to that motion, if you could? Because this actually will result in a budget revision.
Yep.
And so if you could, just so that Beth can record that this is part of the motion, that you are approving a revision to the budget to accommodate this. We won't be, it's not like we're going to be starting this week. I mean, we have some work to do, and employees will have to get these forms out to their former employers, and it won't start until each person gets us the appropriate information, but we'd like to start rolling it out before the end of the fiscal year.
Sure, and I guess that's something that I didn't think about, that we're going to require our current employees to go back to their former employers to provide this, and so that's good information too that I hadn't actually thought about. I was thinking more about new people coming in and trying to get information from their current or prior employer. So, okay, that's great. All right, well then my motion will be that we approve a budget amendment to include a new employee program for experience, and that experience for current and new employees will be capped at 2 years of experience credit. I'll ask for a motion in a second.
So moved.
Never went anywhere. He asked for a revision of the motion.
Second the motion.
It's been moved and seconded to approve a budget amendment for a cap on experienced employees and future employees at 2 years of experience credit. We will take a roll call on this item.
Barnes,
Yes.
Chaplin,
Yes.
Delgado,
No.
Vasella,
Yes.
Hannan,
Yes?
Dial.
Yes, that motion carries. That was our only action item for our meeting today. Our next regular board meeting of the trustees will be Wednesday, March 29th, 2023 at 3 o'clock, right here at the Illinois Terminal. Anything else for today from anyone? Seeing and hearing none, I will make a motion for adjournment.
Second.
We are adjourned. Thank you.